All right. Now let's talk about financial planning. So I'm going to share my whiteboard here. All right. So I'm going to move things. I'm going to be looking down. So why is financial planning so important? Well, let's lay out a real life situation here. And you're familiar with the buckets, of course. We have taxable, we have tax deferred, and we have tax advantaged or tax free. So taxable, just to kind of go back and remind you, right? A little bit of review. Taxable is these are typical mutual funds, anything that's held outside of a retirement account or some kind of tax sheltered account, even if it's deferred or tax free. So that could be your mutual funds you hold at Vanguard, Schwab, Fidelity, wherever, that aren't in IRAs or 401ks or anything like that. It could be your CDs at your bank. It could be your bank accounts. Anything that is in that you get 1099s on, right? 1099s, not 1099Rs. They come out of here. The 1099s for dividends, you're getting them right now. Dividends, interest, short-term gains, long-term gains. So you get reports on these things, 1099s for them, and all this equals tax on an annual basis, right? Every time you get dividends, every time you get interest, so you can't control these things sometimes, short-term gains and long-term gains. Last week, I talked about, I think it was Fidelity or Vanguard, paid out a significant amount of capital gains that many shareholders in their mutual funds were not expecting. So there are what we call embedded gains, and these have to do with mutual funds, and it's very, you can't do anything about it. Sometimes you have to pay tax on gains when your fund's down, as you've heard me say. But anything here that produces a 1099, tax deferred are IRAs, traditional IRAs, 401k, traditional, 403b, etc. Retirement plans, traditional. The promise to pay later. You don't pay tax now, but you pay it later on growth. And tax advantaged or tax free is simple. Anything Roth or some properly structured cash value life insurance. So why is we're going to talk today? We talked last week about Roth. Today we're going to talk about cash value of life insurance. Let's put a green circle around that one. So going back to why life insurance is so important, let's lay out the details here. We had approximately $500,000 for this person in taxable investments. So again, money markets, CDs, not the cash that they need in like everyday checking, but other funds that are invested. In this case, it was all mutual funds, ETFs, and stocks. I think held at Fidelity, but that doesn't matter. And there was $50,000 in just cash. Now, to give you a little more information, this couple needs $80,000 after tax. Their Social Security is about $45,000, and they have real estate income of $10,000, approximately. I'm just giving you round numbers on this group. The issue is that we know that there's a mathematically ideal amount to have in each bucket, right? Each one of these buckets. And we know from our class, if you've been on the class, and if you haven't, join us in March, that we need about 6 months to 1 year, right? Some people say 6 months of expenses. I say it's fine to have 1 year of expenses. I'm a 1 year person. I like to have 1 year of expenses in there available in this taxable bucket. And for these folks, that's about $35,000 to $70,000. And how did I get that? Well, they need 80, 45,000 they have coming in from Social Security, $10,000 in real estate. So even if you adjust up for tax, let's say 50,000 to 100, if you really want to give a nice buffer in there. So they've got a significant amount left over here that is going to be forever taxed. Now, I worry about the $500,000 today, but I worry more about what it could be in the future, because if it's invested and they only earn 6%, well, in 10 years times 10, right? Years, at 6%, they would have $895,000. $895,000. And let me come back to that. So you see, you've got growth in there, and along the way, you're paying dividends, you're paying interest, short-term gains, long-term gains, just by growth alone, $895,000. So the problem just continues to compound. And that affects the tax on Social Security. It affects your future tax rates. It affects everything, because don't forget what the goal is, right? Let's write the goal up here. The goal is, of course, to have a successful financial plan, to meet your objectives, to do what you want to do, handle your estate the way you want to handle it, whether you have a specific amount that wants to go out to somebody, or whether it's just whatever's left passes to whomever you decide as efficiently and effectively as possible. But the goal here, when we're talking about tax efficient planning, is zero tax, or as close as we can get, right? Which is tax efficient. So that's the goal. I mean, this is the best thing. And many people, we can get the zero tax. But if you can't get the zero tax, you want to get as close as possible and limit the amount of money that is subject to what's certainly coming in increased taxes. So they have $1.5 million. So we know they have $500,000 that could grow to $895,000. They have $1.5 million in their IRAs. And we determined that they could probably keep $200,000 to $250,000 in this IRA, depending on their rental income situation. So we've got some money to move here. And the way we would handle IRA, overfunded IRAs, is, of course, shifting it over time to what? To the Roth IRA, Roth conversions over. So we're converting money. You can, as we said in the slot report, you can convert as much or as little as you'd like. Doesn't matter how much money you make. The only question is, how much tax are you willing to pay to get that money over, and what makes mathematical sense? So we convert over a period of time to get that money down. And yes, we also have the growth problem. If they earn 6% every year, then this money is going to, be close to doubling in 10 years as well. So we've got to be aggressive about it, and we push it up to typically the top of the 24% bracket if we have to. Sometimes we go over that, if that makes sense. I know David McKnight has different feelings about that, but in practical sense, we have many clients who the math just makes sense for that. So now let's just say we're successful, and we end up with, by the time we're all done, I don't know what happened there, but by the time we're all done, we transfer this money via conversion from IRA to Roth IRA. And I'm just going to make it easy, everybody, with a little bit of growth. $1.8 million is here. $200,000 to $250,000 is over here. So that's good. We've done everything that we could do to be tax efficient here. The problem is here. Now, can we move any of this money, $500,000, to a Roth IRA? Well, I didn't give you the age, but this person's 62 years old. If he or she is still working, right, because you got to qualify for income, or if their spouse is still working, you can contribute to, potentially, if your income's not too high, you could contribute to a Roth IRA as well. And you could do $7,000 for one spouse. And if you're married, $7,000 for the other spouse, and get that over there as well. So that'll help bring it down. But then we still have a considerable amount of money here. This is where life insurance comes into play. If you've got other funds that you need to move over, or if you just have some significant needs for life insurance, this is another potentially tax-free bucket. Now, you've got to think of it as an investment, because the numbers I'm going to tell you are not insignificant. Remember, we're fighting against growth, and we're fighting against future taxes. Now, if I said to you, if we took $50,000 a year from mutual fund A and moved it to mutual fund B, you're going to have similar growth, in some cases principal protection, and you're never going to pay tax on that again, as long as you continue to have it structured right. You wouldn't hesitate. And that's kind of the same idea. In this example, I'm going to go expand these a little bit so I can grab the numbers. 32,605. We're looking at 32,605 per year. We call it shifting. You can call it shifting, investing, however you'd like, coming out of this bucket into this bucket. And in one scenario, we did times 10. And in another scenario, we did a larger amount, and that was 46,578 a year times 7. And we're going to talk about what that means. That's it, or, right? Either one of those. And there's pros and cons. But that builds in here over time. And if you qualify for it, right? Qualification can sometimes be difficult, but if you qualify for it and your cost of insurance is low enough, then the cost that comes out of here, you've seen this before, that drips out of here is low enough where the majority of the money stays invested in here and can grow over time. And I like to use indexed universal life. There's a lot of different options. We don't have the time to go through them today. I've gone through them in other webinars, but I like universal life, indexed universal life, because the worst you can do from an investment perspective is 0 in any one given year. And good average is 5.5 to 6.5% that you can earn. You can earn as high as, we've had some that do 16, 17%. But let me just see. Somebody's got a question. Let me make sure. Okay. I want to make sure you can see my board. So we've had some that have done much larger numbers, 10, 16%. It's much larger numbers. But assume, this type of return is probably fair. Well, this money grows in here tax-free. And I'm going to show you little snippets of what we call illustrations. This money grows tax-free, and you end up with a cash value in here that you can take out for your retirement or for whatever you'd like. It's not required. It gives you a lot of flexibility. And in this example, let's just grab it from here. Let's see. I'll come back to that, I promise. So in this example, it's $40,140 a year. And I'll come back and show you the details of that. $40,140 a year. So in that example, this person can, after that sat there for 10 years and grown, they can take out $40,140 a year, and that is a tax-free distribution as long as it's set up right. This policy, as an example, also gives them a $500,000 death benefit right off the bat, year one, as soon as you fund it. As soon as you shift in or invest your first portion of money, you get a $500,000 death benefit. If that goes to your heirs, that's also tax-free. So that's good. It's a great return for them if you pass early, but it's not great for you. And if you qualify this death benefit, right, that's a death benefit, that can also be used as a long-term care benefit. So if you need long-term care in the future, you can have money to draw from to help with that care. Now, it's not 100% of the $500,000 in typical cases. They discount it. It can be anywhere between 80 to 95+% of that $500,000, but most of them, you don't pay for it. If you want it 100% of the $500,000, come hell or high water for long-term care, you could find a company that offers what's called a long-term care rider and pay 1.5% for it. I don't see the value in that, but sometimes it is. So that's, you can see here multiple buckets to pull from. You can use this for income tax-free. If you need long-term care, you can draw on this death benefit tax-free. If God forbid you pass away, even whether you use this for long-term care or income or not, your heirs get what's left tax-free. So it can work really, really well. And it gives us a vehicle to bring this down where we want it to be, 6 months, 1 year. So it helps really not eliminate the 1099s, but reduce it enough where it's going to be beneficial. Because again, the goal is, we have an amount that's low enough. Remember this, that is less than your standard deduction RMD, that is less than your standard deduction. So you don't pay tax there. Any distributions from your Roth, of course, are zero tax. You got to follow the 5-year rule and all the things that are involved in that, but most people don't have an issue with that. So no tax here, no tax here, minimal tax here. And depending on what's happening with this real estate, you may have a zero tax situation with your Social Security, but at least it's minimizing the tax of that Social Security. So again, that's the goal. But even if you're paying tax on your Social Security and you can't keep anything in your IRA, you'd certainly want to shift everything you can over to this side, right? This side of the ledger, because, and what exists on this side of the ledger is the Roth and cash value of life insurance. My friend David McKnight calls this a life insurance retirement plan. I got a great book that he wrote if you want a copy of that. But I'm hoping you can see how important this is. It's a shelter against tax. It's an opportunity for income. You don't have to take the income, but you can. You can let it build. I'm going to show you that in a moment. Death benefit for your heirs. So the money, if you need it, can be used for long-term care if you qualify. But if you don't use it, it goes to your heirs to help them out when you're no longer here. It's such a powerful tool. And I'll tell you, I've shared this with you. When I was at UBS, Wells Fargo, I sang the same song everybody sang. Permanent insurance, whole life, universal life is no good, too expensive, blah, blah, blah. Buy term, invest the rest. Completely wrong. Completely wrong. In fact, my 2 term policies are about to expire next year. I just redid all of my insurance, got something exactly like this. I wish I would have done that when I purchased the existing policies when I was 32 years old, right? We can all say that. Wish I would have done it then. But let me give some details here, show you some details of all this string of numbers I just sent you. Here's an example. This is the one example I showed you. I'm going to go back a little bit. This is no income. So I hope you can see these tables. And again, this is just an example of one company. I'm not even going to mention the company because I don't want to get into that. There's several different companies we deal with. But you'll see here, these folks invest $32,000 a year for a period of 10 years. So I don't like it when you pay forever, because I want you to know what your costs are going to be and they're manageable for a period of time. I don't just, if it makes sense, you can put more money in. There's some flexibility there, but I like a finite investment amount, and this works for them. So let me just see if I can make this, since we're so close, I want to see if I can make this a little tinier. Yeah, that might work. All right. So we invest $326,000. You'll see that there is a cash value. We're going to focus on this number here. This has grown an average of 6.2% to $364,000 in cash. There's a $500,000 death benefit even in the first year. And then you'll see that the death benefit over here starts to go down, right? Why in the heck would the death benefit go down? Well, in this case, they start drawing funds out every year, $40,140. Well, that can come out or not come out. They can stay in there. They can be used for retirement income. Some people use it to buy another property, a second home, a new home, whatever. But what happens is loans are taken off of this cash value, and it has to be structured that way. That gets very complex. Most of the life insurance policies we use are zero. That's a net zero loan, or you can use what's called an arbitrage, where you have an opportunity for growth. Again, gets complicated. Each one's individual, but you can see just fundamentally you start drawing on this cash, and we want to make sure that this is going to be around for a long time. So we stress test this. People often laugh, but look at this. We go all the way out. This actually goes out to 120, but if you live to be 100 years old, you've taken from the policy. Remember, you put in $326,000, which is a lot, but it was invested, and you're investing it, right? It was invested over here in Vanguard. As an example, you're investing it over here to achieve the growth, and you're getting still getting a return in there, tax-free, tax sheltered, as long as you follow the rules. If you live to be 100, you've taken that $40,140 every year, $1.2 million you've taken out, and you still have well, in this case, if you died, yeah, either one, $287,000 goes to your heirs, or $335,000. So that's if you're using the income. Now, let me just show you, if we don't use the income and we just say, you know what, and you don't have to decide until you start drawing, and you can decide year to year. Well, look at this. This is the same scenario. $326,000 gets invested from forever taxed and never taxed. Back over here to the $500,000, it's the same thing. $500,000 death benefit in year one. You'll see here that it starts growing here. Do you see that? It starts growing because no money's coming out. your cash value is growing. So the IRS requires that the death benefit go up. The IRS is savvy to this. They know that people are using this as tax shelters, and they're not going to just let them build up cash value and keep the death benefit, way down here. It has to truly be life insurance. But you'll see here, what are we at age 81? If you decide hey, listen, I don't need the $41,000. Well, it's not like a IRA where you have to take traditional IRA where you have to take it. You have flexibility. Now your death benefit is now $800,000. And don't forget, this could also be potentially a long-term care benefit if you need long-term care. So that's beneficial. And if we continue, you'll see at age 90, many of you are going to live to 90. You still put in that same $326,000. It's now $1.5 million of life insurance that's going to go to your spouse, your kids, or is available if you meet the requirements of long-term care. So people like that. I like the flexibility. I like this level of coverage here because this concerns me quite a bit for everybody, including myself, and certainly my clients. So the nice thing about these structures are flexibility. You have the ability, if you wanted to go and take that $40,000 a year, you can, and you, again, flip the switch on and off, or if you wanted to continue to build, you can. That's why I think it's so powerful and so important to tax efficient financial planning for sure. Just one other point, and I'm going to sign off. You can structure it many, many different ways. This is the same amount of money, just over a shorter period of time. In a comparison, you would see that the cash value grows significantly more. You remember that there was about $793 or $793,000 worth of death benefit. This one would be over $890,000, I believe. But remember, with the other strategy, paying it over 10 years, shifting that money, investing over 10 years, we could take out $40,000 because this same $326,000 is invested over 7 years in this example. And because there's more time for that to grow, you can actually take about $5,000 a year more if you wanted to. So there's many ways to skin this, but so important to financial planning. I am always elated when my clients can qualify for these. It just helps. It helps to have another bucket to pull from. I'm going to bring back the scribble here. There we go. Coming back to the beginning. Let's just bring this down. Okay. All right, folks, it's 11 o'clock. I hope you have a great week. We talked about the markets. We went over the slot reports. I told you when David McKnight is joining us. We have Sarah Brenner coming up as well. We have a class coming up. We reviewed the value of life insurance and financial planning. We talked about our transition. Just please be patient with us. We have it's a tremendous amount of work, but it's good for you. It's good for us. It's really going to be fantastic. We do have a couple questions. Let me just see here. So Hank asks, can you take periodic distributions from the life insurance? I'm assuming. Yes. There's a certain period of time where it makes sense, usually about 10 years. You can take it sooner if you're funding it, say for 7 years. You can take it in year 8. You just want to look at it each and every year to see what makes the most sense. And we also, I showed you 40,000, 40,000, 40,000. It doesn't have to happen that way. We actually check in with the insurance company each year to make sure that we're not violating any IRS rules because we don't want it to become taxable. You got to be careful with these things, but we help be careful. Gerard says children or grandchildren should fund it. Yeah, I guess that would be the best for you. But if you still have to do something with that money that's in that taxable bucket, right? But that's another strategy too. So if your children or grandchildren have a lot of money that they don't know what to do with, and they're going to be taxed and they're worried about that, sure, they could fund it. They don't have the same benefits you have about taking it as income and long-term care. They're just solely basing it on the death benefit. And Gerard also asks, how are RMDs taken from qualified annuities? Can they be converted to Roth whole or in part? No. So qualified means IRA. Annuities are treated just like any other retirement account in the regard of RMDs. Sometimes there's a little bit more of a difficult calculation depending on what kind of guarantees they have. But no, RMDs cannot be converted. So in fact, you have to take RMDs first before you do any conversions. So good question. No, Gerard. All right, folks, it's a little over. I hope this was beneficial. We'll see you next week. If you need us for anything, reach out. If you want to schedule time, I think all of February is blocked. If you're a client, though, jump in, call us. We can certainly get you in. We blocked off for these kinds of webinar follow-ups and non-clients while we're working through transition. But clients, please, if you need us, reach out to us. Have a great week, everybody. Take care.